Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's September 11th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So, I just created a new indicator. It's called the bullshit indicator. Where we call bullshit on some of the crazy predictions we see from so many of the so-called experts on Wall Street. Now, why am I starting off with this segment? Right at the intro? Because lately, I don't know, might be me. I comb the market just like you guys. But I've seen tons of end-of-the-world stories throughout all financial media. It's like they're throwing, and not only am I seeing them on these sites, but a lot of these sites list when you scroll to the bottom, like their top 5 stories, and they're always in the top 5. In fact, I can't remember a day that's gone by, and I mean this, I should say over the past couple of months, it's been over the past like 6-7 years, but it's really getting crazy right now, where you don't see some crazy outlandish prediction of where the markets are headed. Like one of the headlines is next recession will destroy millennials. Or signs that a U.S. debt-fueled economy might actually collapse. Drowning in debt, the road to $30 trillion. How federal debt will soon destroy the U.S. These are real headlines, guys. Our debt-to-GDP ratio is over 100%. That's the danger zone. I'm not going to break down where these stories are, but they're all from very quality, very popular financial media outlets that we all look at and read. But every single day that goes by, more and more of these are starting to show up on these sites. So what I want to do today is cut through all the BS, because many of these calls are like being part of WWE wrestling. I mean, hey, it's very entertaining. People love it. It's great. I grew up on it as a kid. But watching wrestling is harmless. We all know it's entertainment. So many people enjoy it, and that's cool, giving the people what they want. The people in the financial media making these calls, they're influencing your lives. That's a big difference from just being entertained for a TV show or something like WWE or whatever, or an interesting story. They're influencing your life. How? By making you do the wrong thing with your money over the past 10 years. And think about that. That's money you could have used to put your kids through college, retire early, take your family on a nice vacation, buy a new house, have some extra money to pay your ex-wife after your divorce, whatever. I'm not playing Monday morning quarterback here where, hey, if you invested, you could do it all over. But there was signs out there that showed that the markets were going to go a lot higher that, frankly, the bears don't even care about. Why? Because most of these people have an agenda. They want to sell you something. And the best way to do that is to tap into your emotions, especially your fears. Telling you, hey, you're going to lose everything if you don't do this. And of course, they're going to provide a date, right? Usually within 3 to 6 months. Some of them have a specific date saying the market's going to crash on this date if you don't do this, this, and this. And it's funny that they're selling financial newsletters and they're telling you it's going to crash. I don't know how they're going to help you make money. Whether they can tell you to go into cash, I don't know. But it's just funny when you see it. But they, that specific date. Why? Because it creates urgency. Whoa, I really need to see what this guy's saying. He really thinks next month the market's going to crash that day. Holy cow. But that's the game. For example, if you take Peter Schiff's book from 2011, it's Crash Proof, it was called, How to Profit from the Economic Collapse. And then he published another one in 2012 called The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. That was 2012, How to Save Yourself and Your Country. 2016, same book, except he updated it. He actually called it The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country, updated. Get the word updated. So he updated that book, right? Called it for the crash. I won't even say 2010, 2000. Let's start 2012. So what do we have here? Very scary titles. Taps into your emotions. New York Times bestseller. You get scared, you buy his book, and then you're in his ecosystem of email barrages, sales pitch to buy gold, invest in his funds, whatever. I'm highlighting Schiff as an example because Schiff is someone that I think you guys know how I feel. But there's a lot out there. And if you want to put all this into perspective, what's not being told is when you look at 2012, when he made that prediction from 2016, again, that's the time when he revised his America's Coming Bankruptcy book. The S&P 500 went from 1,400 to 2,600. It surged 65% from 2012 to 2016. I'm not picking on him because he's wrong. A lot of us get it wrong from time to time. There's a reason why I'm bringing him up. Because from 2016, when he wrote the updated version, the S&P 500 went from 2,600 to where is it, around roughly 3,000 today, give or take, a few points. So again, putting all this in perspective, you have a guy like Schiff's been predicting America's bankruptcy pretty much since 2010. I won't take the generational low, though. I won't go there again, which was really from March 2009, but from 2010. But again, let's just use 2012 as an example. That's when he wrote his first America's Going Bankrupt book. And the S&P 500, again, trading at 1,400. Today, it's close to 3,000. So not only do you miss gains on one of the biggest bull markets of the generation, marks up 135%, the S&P after dividends, which will only cost you 0.04% to own the Vanguard S&P ETF. But more important, Schiff is charging as much as 4.5%, which is the max sales charge he charges for his funds. 4.5%. You know why they're not in America now? 4.5%. That's on the way in. You probably don't know you're going to get charged on the way out. Even if you're losing money, you leave, bye-bye, you get another fee. Crazy. Insane. When you think about that, 4.5% to put money into his funds, which, by the way, just about every one of his funds, including his gold fund, has underperformed the markets over the past 3 years, 1 year, 6 months, 3 months. You pick the time frame. Most of them since inception. So not only did the people listening to him miss one of the biggest bull markets ever, even if the market crashed 50% from today's levels, the S&P 500 would still be higher because it'd be around 1,500, right? It's 3,000 today, compared to when he made his crash call in 2012. Even if it declines 50%, which is going to say, I told you so, it's still going to be higher than when he made his original predictions. Now, I'm going to say a few things here. And at first, you're going to think I'm crazy. I'm sure most of you disagree. You're going to think I'm on drugs. Hear me out first. Because there's a lot of fears out there, like deficits. And I'm going to let you know a little secret. Deficits don't matter. How crazy is that? You probably want to show the pot. What are you talking about? Deficits? We're sitting on $22 trillion in debt, which keeps rising. And it looks very, very scary on the surface. Again, it's $22 trillion. It makes for a great story. It's awesome. Did you know people have been warning about our massive deficits since the 1970s? In the 70s and 80s, there's still some analysts out there today that have been doing this that long. And you could take what they're saying today, and if you see them do a conference or a video, you wouldn't even know it, but it's the same exact thing from the 70s and 80s. Country's going to be destroyed. Move your assets out of the U.S. The dollar's going to get destroyed. Riots in the street. Same thing. Let me tell you something. You were alive back then, and I was born in 72, or should I say maybe old enough to invest in the 70s and didn't take any money out of the market, even the 80s. Congratulations. You're a very, very rich person. Now, when it comes to our debt, believe it or not, there's not one economist on earth that can prove high debt levels alone are bad for an economy. Any economist that tells you different is not a true economist, because debt usually fuels economic growth. Look at people and businesses have more money to spend, and most of this lending, which is done by banks and large financial institutions, it's carefully analyzed. Where banks are not lending $1 billion to a company generating $2 million in sales. No, it doesn't work that way. Very, very careful when it comes to who they lend money to. Similar to an insurance company who knows every single risk before writing you a policy, which is 100% all the time in their favor. Wow, if I die, I'm going to get $10 million. Believe me, they know you're not going to die. They know. They have algorithms and numbers. Yes, that rare instance when that happens by accident, God forbid, but most of the time they know exactly what they're doing. They know the numbers, they analyze everything. Again, it's in their best interest to know that. Their job is to take money from you and not pay you. That's their job. They're not going to tell you that. They're going to say, hey, you should be safe with your family and this and that. But in reality, there's a reason why the insurance companies are the biggest businesses and most high-margin businesses in the world. There's a reason why hedge funds have created reinsurance companies, which is insurance on insurance companies, so they could take that pool of money, because one of the only businesses that you pay money up front for something in the future that probably won't happen. And they take that and they invest it within their fund to generate more returns. And if something happens, they pay out. Big deal. It's the greatest industry in the world, insurance. They know exactly what they're doing. But getting back to debt here, debt fuels an economy. Now, say we have another 2008-like credit crisis, right? Which is going to be really tough to happen, since it's not going to be caused by the banks, since they're barely leveraged today due to new regulations, Dodd-Frank, which were put in place during a credit crisis. I know a lot of you might disagree with that, but they were super leveraged. I say this all the time. Subprime did not cause a credit crisis. It was the leveraging of subprime. If nobody leveraged subprime, there would have been a pullback in the housing market. Yeah, a couple firms here and there. It was the leveraging where people have to put up the money. It was leveraged 40, 50 times. Synthetic CDOs. That's what crushed the markets, guys, not subprime. It was the leveraging of subprime. That's what killed it. Banks are barely leveraged today compared to how leveraged they were historically. So let's go back to an example where we have a complete meltdown, another black swan event that crashed the global markets and puts us on the brink of total worldwide collapse. My question to you, what do you think the government's going to do? They bailed out everyone during the credit crisis. You know what? They made an effing fortune. Fannie and Freddie paid over $300 billion in combined dividend payments to the government already. $300 billion. If you want to put that in perspective, the total amount of the bailout was $470 billion. It wasn't the 700, whatever. It was $470 billion when all is said and done. Fannie and Freddie paid over $300 billion in dividends combined to the government already. The banks paid back the $245 billion, which is a $545. Again, the bailout was $470. And not only that, the banks paid that back by 2012. 4 years later. Throw in the bailouts for AIG, GE, the auto companies, everyone else, and the government made an absolute fortune bailing everyone out during the credit crisis. Which you may say, well, okay, that's good because now it put us on much better footing. And, people forget. If that would have happened when our unemployment rate would have been 30, it would have been Great Depression. And we might still be in it today if that would have happened. That's how dangerous that was. I say, yeah, well, they I don't know, some people are against it, for it, regardless. What you need to understand is it wasn't a good thing that the government made a fortune bailing everyone out. Because what do you think the government's going to do if the market falls 35% or another black swan event? I remember towards the end of last year, the market corrected by 20%. Again, it was up like 15%, so it wasn't like the market felt it. I think it was down like 6% on the year. And what happened? Trump quickly made sure he started talking to China again. Relationships are not that bad anymore. And the market really surged to the first few months of the year in 2019. And he talked about providing more tax incentives again. It's like everyone's afraid the market's going to come down. It's crazy. But remember, America has a printing press. We could print money forever. I hate that fact. You should hate it. But I'm not talking about it from a political view. I'm not talking about trying to tap into emotions here. I'm talking about how you make money off of this, which is the only thing you should care about. You can go on social media. You can hold up a sign in front of the White House. Do whatever the hell you want. I don't give a shit. My job is to make you money. And that's what pisses me off about all these bears, because lowering interest rates to near zero, backstopping all the debt, and you're still keeping your bear forecast on there means that you have an agenda. You don't really care about people. But you look at it as America with the printing press. Again, I don't like that fact. I'm not saying like, wow, America's got a printing press. She's got nothing to worry about. No. I'm telling you what the government's going to do if this happens again. They're going to bail out everyone because they made a fortune. You're looking at the dollar. Dollar is the world's reserve currency. Everybody wants it. By everyone, I mean every country, because it's safe. Now, this will end badly one day, especially if our debt levels keep going higher and higher and higher. If we don't see economic growth, because economic growth is essential when you have debt on your balance sheet. So I say these deficits don't matter. We're growing the economy. If we continue to grow the economy, until it goes forward, we're going to be fine, especially when interest rates low. So that's one thing you can say what debt is terrible if you're not growing, or excess debt, I should say. That's bad. But let me tell you something. if we do see the tides turn when it comes to our debt, and all those fears that you worry about that people have been telling you at least over the past 10 years that you can remember. That's why I bring everyone on board, because everyone's always talking about the last 10 years. Dollar's going to collapse. The market's going to collapse. Everything's terrible, right? Everything's horrible. Say if they're right. You're going to have plenty of time to see it before it happens. And remember the credit crisis, 2006, 2007. Look at the news flow. You could go into it now and Google it. Hey, mortgage companies started to go bankrupt. Default subprime mortgages started to skyrocket. Again, 2006, 2007. AIG took insurance from every brokerage firm for all the shit to backstop it. We didn't know behind the scenes, but we saw the writing on the wall of what was happening. So what's going to happen this day? You're going to see defaults rise sharply for businesses. If you're worried about debt and debt becomes a major concern, which is not happening. Foreclosures skyrocket, which is not happening. Interest rates surge, which is not happening. GDP falls sharply, which is not happening. You're going to see it in the bank's balance sheets, which still have to go through extensive stress tests every single year, which, by the way, banks are reporting record earnings, some of the highest credit quality and loan metrics, near record common equity tier 1 capital. Very important measure. You don't have to know it. Don't write it down. It's just basically, it's the funds a bank has on its balance sheet to absorb losses in case of, without seizing operations. So they have to keep a certain amount basically in reserves. Those are near record highs, which explains what. They had to keep that much money in their balance sheets because we're so scared of another credit crisis. Again, that pendulum swings all the way to one side. That's how it is with regulation. So what are these banks doing? They can't really grow. They can't really take on as much risk. What are they doing? They're raising their dividends like crazy and buying back a shitload of their floats. Citigroup, Wells Fargo. I mean, in the next 2 years, because it's basically a 3-year process, they're going to buy back 20% of their floats. 20%. And these companies are paying what? 2, 3, 4% yields. That's how much money they have. People don't want to talk about this. They don't want to talk. They want to scare the shit out of you. It's like, no, Frank, you have no idea what you're talking about. Whatever. We've been in the market. We've generated a lot of money over that time. You could do whatever. It's your money. It's important. But I just want you to hear the other side. And don't be like a left or right politician where it doesn't matter what you say. It's a religion. I don't care. Listen to what I'm saying. Disagree with it. Do your own homework. See if what I'm saying is real. But you're looking at the banks in very, very more powerful than they've ever been in the history of our nation. Throw in interest rates. Going to remain historical low for a very, very long time. I won't say forever, for a long time, which allowed the government to borrow indefinitely. But for now, please do me a favor. Stop worrying about the debt, the deficits, the $22 trillion that people talk about since 1970. It's going higher and higher and higher. And breaking it down between Obama and Trump and how much money they're adding to it and why they're terrible. Whatever. It's nonsense. It's noise. It's noise. It's being brought out today because we have an election coming up. You're going to see all this crap coming out. Scare the crap out of you. But stop worrying about the debt. Because this risk alone has kept so many of you on the sidelines for 9 years. For 9 years, where the market and almost every asset has significantly increased in value. And even if you didn't get it right in 2009 or 2010 or 2011, by 2012, the writing was on the wall that our government, our Fed, all in doing everything they can to inflate the markets, keep interest rates at zero, which is a recipe for almost every asset to skyrocket in price, which is happening. And it didn't really skyrocket that much. I'll get to that in a minute. That's relative to, earnings and what's going on. If you're looking at super low interest rates, huge deal. We have earnings growth of the past 5 years along with sales growth. Unemployment is basically zero. Consumer spending is still strong. So it's funny how many stories out there right now, or even over the past few years, they're just telling you, hey, the markets are so expensive, so expensive. You know how expensive the markets are? They're so expensive, you won't find one expert anywhere that's telling you the stock market is cheap right now. Nobody would tell you that. The stock market is cheap right now. No. It's like you're not allowed to. It's like if you're in Hollywood, you can't say that you like Trump or you're blacklisted. You're not allowed to say that in financial media. It's crazy. You know what? If you long, that's a great thing because that's a huge contrarian indicator. Nobody believes the stock market's going to surge from here. Nobody. Very few people. I'll tell you something else no one's going to tell you. That our stock market is cheaper today than it was 4 years ago. That's a fact. Looking at the numbers. I mean, S&P 500 is trading at 16.6 times earnings right now, forward earnings. The 5-year average is 16.5. We're right on it. If you look at the markets, they're not expensive today. And are even trading at a discount to where it was trading in 2011, 2012, based on a PE base, forward PE. And you may be thinking, Curzio, you know what? That makes zero sense. I mean, stocks are up huge since then, and you're right. But it's about earnings growth. Because earnings are also up huge, which is why the P in the S&P 500 is cheaper today than it was 5 years ago, even though the market's higher. But I wouldn't go out there and say, hey, the market's dirt cheap. You got to go in and buy. No. But they're definitely not expensive. You're looking at earnings down slightly year over year, which is to be expected since we had the tax cuts go into effect last year. But for 2020, expect to grow close to 10% again. Throw in super low interest rates. The environment's going to stay here for a long time. A near 2% yield on the S&P 500, which was actually higher than the 30-year Treasury, that yield, a few weeks ago. And stocks are definitely not expensive. Provides a good alternative, especially in the global markets where everything doesn't look all rosy out there. Again, something you won't hear in the media. Why? Because it doesn't sell. Greed, of course, sells, but nobody's predicting the S&P 500 to go to 5,000 anytime soon. You don't see any of those predictions. If you did, then that'll get people interested. Most are predicting a 30% plus crash because that's really interesting to people. They would click on a story like that. They're like, whoa, if that happens, what's going to happen to my 401k? And that's why a guy like Peter Schiff is still quoted everywhere. TV, gets paid to speak at conferences, huge draw, good for him. Because he gets that despite having a terrible track record and being wrong for 9 straight years. So what kind of person do you want to be? You want to be a follower or a leader? If you want to be a follower, go follow the guys with these crazy predictions. It's fine. I'm not a perma bull or a perma bear. When I see the data telling me that we got to get out of the market, I'll be the first to let you know. But it's not saying that right now. So I've been telling you to buy almost every single dip for a while. I got nervous before the tax reforms and said, look, we're getting a little top heavy, but the tax reforms changed the game. Added more earnings growth. Companies are paying less taxes, generating more money. When you're looking at people like that, it's entertaining. People love to read stories, watch videos of crazy market predictions, which essentially means more page views, right? Or more money to the networks. That's their motivation. They need you to click on stories. And today, everything's a 24-hour news cycle, as you know, especially when it's not earnings season. There's nothing to talk about for even 3 hours, 2 hours. Maybe there's one good story in the market. Same with ESPN. I mean, now you have football, which is good, but a couple of weeks ago, before football is like they're talking about how Jerry Jones pissed off Ezekiel Elliott by saying, Ezekiel who? And that offended him. I mean, that's what they're talking about because they have to talk about something even though it's meaningless and it means nothing. It's the same in the markets. There's a lot of noise out there, and you have to be careful. The point of this mini rant, if you want to call it, don't fall for the dollar's going to lose its reserve currency status stories. Don't fall for the market's going to crash by 40% by the end of October, which October is the month where we see the biggest crashes. Or if we have an inverted yield curve every single time it's a recession, we're going to have a recession. When people aren't telling you that the S&P 500 goes up an average of I think it was 17, 18, 19% around that level. I had that quote. It was amazing. Great research. Before the actual recession. Nobody tells you that the market surges before you actually have that recession. Think of 2005, 6, 7. Before we had 2008, how much the markets went up. Look at the internet bubble, how much the markets went up before we got a bubble. We're not in a bubble. We're not in a bubble. We're not in a bubble because everybody predicts the market's going to crash. That's how you know we're not in a bubble. How many markets have crashed when everyone's predicting? Let me know. I've been doing this 25 years. Never happens. You had only a few guys predicting that the housing crisis and how that market was going to happen. That's when you see it. Now when everybody's talking about it and being worried about it, everybody's cautious. It's on the table. We all see it. We see the risks. And please, please, please don't fall for the U.S. has too much debt and it's going to go bankrupt story. Which, by the way, if it happens, Why would you care about reading what anyone has to say? You should buy a cave and protect yourself, weapons. I mean, if that happens, it's going to be mass chaos. But you should buy my newsletter for $100 because this is going to happen next month. It's great. It's great. It's entertainment. But entertainment's cool. We live for entertainment. We all do. We love it. That's why we have to be on our phones. We have to be doing something. I get it, but this is your money, your generational wealth. That's what these people are fucking with right now. And they don't get that. They don't get how many people are listening. When Schiff goes, he doesn't understand how many people listen to every word he says. And so many people have been out of this market and said, hey, you know what? I'm going to trust you. I'm going to go into your funds. They're underperforming. Well, I'm going to get out of it. Okay, here's a 2% charge you're getting out of it. Really? Yeah. 4.5% fees. 4.5% fees. That's great. Unbelievable. Be smarter than that. Be smarter than these people. Because at the end of the day, it's about making money for you and your family. I've been doing this for over 25 years. I love what I do. And I can tell you, most people don't give a shit about you. They give a shit about making money for themselves. And if you have that mentality, especially when you're seeing these crazy headlines and stories, you're going to think a lot differently going in. And that's what I'm trying to help you with. Now, end of the rant. Let's move on a little bit because I have a really cool interview for you today. And it's with Daniel Creech. Daniel's an analyst at Curzio Research. Worked side by side with me for 2 years when I hired him. Interviewed him a little over a year ago. And remarkably, I got a lot of questions from you, listeners. Hey, how's Daniel doing? I'd like to hear what's going on. And just a little bit of backstory. And you haven't had him on a long time. But Daniel's been an amazing hire. I mean, I had to kick the guy out of my office because he loves his job. I said, get out of here. Go, go, go. He's always here. He loves what he does. And you're going to see this in a minute, but he's turned to a full-fledged stock analyst who is going to be writing a few of his own publications soon. Very soon. Now, there's going to be a straight-up interview. Dan's not going to kiss my ass because he works for me. It's going to give you a behind-the-scenes look at what it's like to work right next to me for a long time, the positives and the negatives. One of those negatives would be, man, my daughters come into the office, say hi sometimes, and they like Daniel. I think he's a great guy. They go in there, which I know he kind of likes. But Daniel's also going to talk about the tools he uses to research stocks, including several methods you could do right from your home. And he's going to share his favorite picks with you. They're not my favorite picks, they're his favorite picks. I never tell my analysts what to write, what to recommend, nothing. So these are different stocks that, trust me, you're not going to hear of any of these names, maybe one or two. It's going to be about 4 or 5 stocks, new ideas to look into, really cool. And just a quick heads up, because if Daniel's wrong on any of those picks, or you want to write in criticizing Daniel, just know that he is 6'7". If he finds you, he's going to kill you. I'm kidding. I'm not kidding about the 6'7" part. He's a big fella who could actually hit a golf ball a mile. So really, really great interview coming up. And you're going to be surprised, I think, because you guys listen to all my interviews and analysts. Wait to hear him in just 2 years. It's going to be pretty remarkable. Then in my educational segment, I'm going to break down a very popular stock that had a PR nightmare. One of the biggest. Cut its stock in half. Today, it's trading at an all-time high. So this segment's going to be about risk. More specifically, the difference between a secular risk, which is long-term, and a short-term risk. Because if companies can turn it around, and a lot of times when you have that PR nightmare, these stocks get crushed. But once they figure it out, and most do, their stock prices go a lot higher, and you're able to buy them for dirt cheap because they just sold off. And that's what happened with this company. So the best part, now I'm going to break down this company to all-time high. I won't give it to you. Maybe you know what it is, just by some of the things I've been saying so far. I'm going to give you a stock that's in a similar position today, going through a PR nightmare, that could follow the same fate as this once hated name. It's going to be a great segment. Trust me on this. I give you a great stock pick, something that's come down a lot. That I think is a screaming buy right now because they're going to figure out this problem, just like so many companies. But a lot of times when you see brand name companies and great names really mess up, most of the time they become stronger, put new measures in place, and that stock price benefits years later tremendously, and you're able to buy at a discount. So fantastic segment. Trust me. It's going to come in a minute. Before we get to that, let's get to my interview with Curzio Research Analyst, Daniel Creech. Daniel Creech, thanks so much for coming back on the podcast.
Hey, Frank. Thanks. Great to be back.
So basically, you could just walk over one office and really do this interview, but you're now back in Arizona. And talk about that a little bit, because you worked for 2 years, just to give everyone, I've interviewed Daniel. I think it was after 1 year you were here. I think it's not around 2 years. And now I have you back on to give you like an inside scoop of what's going on. And talk a little bit about the transition, because when you came here, I said, look, whoever's ever going to work for me, who I hire as an analyst, I want to come here for a 6-month period. And you decided to stay pretty close to 2 years. Again, now you're back in Arizona. But talk about that whole process moving here and how it was, because the amount of work that you've been doing for us is amazing. But even before we get to that, talk about the whole transition and how that was for you.
Yeah, it was a drastic change, that's for sure. Took me a couple days. I packed up and just drove from Arizona to Amelia Island, and just had fun with it. Just enjoyed seeing the country and taking a road trip. And now you could blame me for not being able to read a map, because I actually left the island. I ran out on Frank when the hurricane was looking like it was going to hit us. So I'm originally from Ohio, so I actually drove to Ohio, which is where I'm at now, and I'm going to make a big loop basically around the country and make my way back to Arizona probably in the next month or so, to tell you the truth. But yeah, the deal was to live on the island for 6 months, but not to sound arrogant, but I have to be in one of the top runnings for the best job and the best life in the world, because I'm not married. I don't have kids. So after 6 months living on the island and working right next to you, you twisted my arm and said, hey man, you can stay a little longer if you want. So I took advantage of being, like you said, right next door in the office, and then hitting the beach whenever I could. So yeah, it was a big change, but it's been amazing. It's been a great experience, and looking forward to the next couple of years and beyond.
Now, like most people, when we put out a resume for a research analyst or anything, a lot of people are familiar with the industry. Maybe they're, for Agora branches, it's Money Map or Stansberry they're subscribers to, or Agora Financial, or even, some outside of the Agora networks. So a lot of people are familiar with this industry. What was so different when you actually, because I knew that you read newsletters. I think you might have read my newsletter when I was at Stansberry before I started Curzio Research. What did you learn about this industry that you didn't really know about once you got here, or within those, especially the first few months that you started really getting everything down pat and just throwing you right into the system?
Yeah, I started my background. I've been interested in the newsletter business for several years now. You're right. I started reading your work when you were at Stansberry. I have a background in finance. I was in the brokerage world for a short time and have an insurance background. But the biggest thing I learned was that you can, if you put in the hard work, you don't have to go through your typical brokerage avenue or the typical financing avenue to go work at an investment bank. And you mentioned how you didn't kind of look at typical resumes when you hired me. You just threw it out on your podcast, and basically, and it helped me tremendously because, I didn't go to a popular school that you've ever heard of. I graduated, but like I said, if you don't have this Yale or big time college name, it's kind of hard to break into some of the investment world. And the nice thing about what you did was you basically just said, hey, tell me why you would be good at this job. So if you put in the hard work and you have somebody, I'm grateful to get to work next to you who's grown up in this business and obviously had some success, a lot of success. But the exciting thing is just to say, hey, it really brought it home to me that says, hey, if you're willing to learn and you're willing to put in the time, it's a lot of time, a lot of work, but if you're willing to do that, you can really make a great living and you can help a lot of people make a lot of money. So that was really kind of the full circle for me on thinking, hey, how do you break in this? And almost one of those things where can it happen to you sort of thing.
Yeah, no, that is interesting too, because it's, and I say this all the time, and even if there's business owners that listen to this as well, you could teach everything to somebody that right? You could teach, whatever it is, whatever business you have. If it's a, mechanic or whatever, you could bring someone in. What you can't teach is hard work ethic, right? You can't teach that. So if you have that and they're willing to learn and put your ego aside, you could learn almost anything. You could do almost anything. And that's, in that interview process, that's what people want to see. So it's not so much a resume. You could have went to wherever, which means, hey, maybe I'm good at remembering things. So I did good on all my tests. If it's an Ivy League school, I'm not putting them down at all because, it's a very tough process. And a lot of those guys are pretty much set up once you graduate there to go to numerous places. But with this job, and even some of the Ivy League people that I've interviewed, there's a little bit of chip on their shoulder. And I don't know if they know how to get their hands dirty, if they know how to work hard, if they're going to have to work on the weekends if that happens. And, for me, I'm always pushing people out of the office and saying, hey, guys, make sure you have time. Don't get overloaded. I don't want you to hate your job. But at the end of the day, you really have to like what you're doing. And that's what I wanted to get to the next question is, what are some of the things that you've learned, especially when it comes to the analytical side? I mean, the research engines that I have access to, and guys, I try to provide so much free information for you, where things you can find out, different research engines, but we probably pay anywhere from $75,000 to $100,000 a year for the research engines. We need that because it gives me stuff very, very quick. And now that you have access to that, talk about that research process, because now that you've been helping me write up stocks and going over, names that you like, talk about that whole process, because I'm sure that was a little bit different from what you thought when you did get here.
Yeah, absolutely. I knew, obviously I know there's going to be a lot of research, but it was a little overwhelming at the time, but all in a good way, because when you sit down to, one of the coolest experiences was just kind of, it's funny when you first get there, your expectations, you're a small company, your expectations are relatively low. So you're just soaking up and learning. As you're there a little bit more, you gain responsibility, and you need to kind of, pull your own weight and contribute. And it was just so neat to see the process of, hey, you screen for stocks, you talk to all your contacts, you just sit down and really think about, hey, what's going on right now? What are most people thinking? Is that correct or is that wrong? And we're always looking for data to back it up. So it's just amazing how, take you, for example, you always have a list of stocks. I always have a list of stocks now that you're constantly looking at or monitoring and thinking about writing up. And then you start the process of looking through transcripts and company reports and looking at earnings. One of the biggest things I learned was to think about a catalyst. And I know that, this is repetitive for your listeners because you drive this home. But honestly, it really didn't sink in for the first 6 or 8 months that you were like, listen, revenue and earnings drive stock prices. And you can look at a lot of different companies that, through a quick screen, they look like solid companies or brand names, but if they're not growing, it's basically dead money for a while. So that whole research process on trying to figure out, hey, what's everybody thinking about, and why are they right or wrong, and we need data to back it up. You mentioned some, how you pay a lot of money for some research engines. Capital IQ is one of the best ones out there, in my opinion. That is a paid-for subscription, but it's just wonderful to, at your fingertips, be able to pull up all kinds of company reports, any types of numbers and ratios from any number of years going back, and really see, has management been sticking to their work? Can they deliver on their promises? And really focusing on that catalyst and what's coming up next.
Hey, Dave, talk about the writing process, because one of the most difficult things, guys, out there, if you're thinking about getting into this business, I get a lot of emails, and we're going to get some, Daniel's favorite picks soon. I know that's what this podcast is about, but I like giving you an inside scoop where you're not hearing it from me, hearing it from one of my employees who worked. And Daniel's one of the few people, because a lot of my employees are mobile now. We're up to 17 employees here. And he's one of the ones that was in the office all the time. So he knows everything about me. I mean, one of the negatives is probably my kids coming in whenever randomly and they love you, Daniel, and say hello and everything. And another thing is probably my mascot. I don't know if you wanted to mention that, something that you really hate in our office, right?
Yeah, we, for those of you that don't know, the biggest thing I can tell the public about the inside scoop of Frank Curzio is he's basically like an animal whisperer, or basically starting his own zoo. We have all kinds of interesting animals. Well, you have a snake and a rabbit, and I will say I was disappointed when I didn't hear it was Thumper. But the snake is definitely not my friend at all. I'm not a snake fan, and everything's in cages and stuff. But yeah, the work environment was awesome. The kids run there. Make sure you tell the family I said hello. But yeah, I'm interesting to see when I come back here soon and visit what the office looks like.
Yeah, my daughters love snakes. My daughters love snakes. You believe that? Insects, all kinds of crazy things. So yeah, sometimes it's just easy to have it in the office really close to the house. But getting more into the process is and I actually, this is the beginning before we got to this, so a little sidetrack. But the writing part, because in our industry, it's very difficult. It just doesn't match. It's kind of like, I guess you could say a good example is baseball, right? You usually don't see. I think there's like 4 main, just qualities, whether it's strength, and you get home runs, you get the fielding, you have speed, and it's very rare, right? It's very rare to have all those. And when you do, you have someone that's perfect. In our industry, it's very difficult to get people that are great analysts that know how to write. talk about the writing process, because when I say know how to write, people know how to write, but what we do is we're going out to, this is an institutional, right? I worked on that side already, where I could just say, hey, this company's trading at EBITDA, well, it's 5 times EBITDA, it's a cheap discount, and these are the catalysts, and that's all I need to write on the institutional side. That's just it's much more detailed sell-side analysts to have, discounted cash flow models. It's mostly numbers, but they don't tell stories. And our job is to get mom and pop interested and dial it down and get to the details and explain everything. So when we say EBITDA, we tell you earnings for interest tax, so we'll say all of that, but talk about the writing aspect, because that's something that even someone for me who's been in this industry for such a long time, you're always learning how to communicate, because at the end of the day, we're communicators, right? We want to communicate to you. And if we're not communicating an idea that makes sense or that you understand, you're never going to invest in it. And talk about that process and how detailed it is.
Yeah, absolutely. It is. The short answer is it's the most humbling thing I've dealt with professionally. It's funny to sit down and work for hours and hours on something and rewrite and try to, make it flow. And like you said, we have to engage with our customers, because our subscribers, we have to get them excited about something, because a lot of times they'll just ignore it. If we don't catch their attention, they may just, whatever, we'll look at next month's issue or whatever. But it's just incredibly humbling when you put in the time, you send it off to editing, and you even gave me, you still warn me to this day on it. So, hey, don't take it personal. It's going to come back with a lot of edits, a lot of red ink on there. That's just a learning process. And, you just have to go through it. Everybody, me in general, I just nod my head. Yeah, okay. But boy, when you get it back and you think, gosh, it was that bad, or, you read the same thing or write it over and over and over again, and then you kind of get glossy-eyed, and you just your edits come back and you make really silly mistakes here or there. But the editing process has been great, though. It's fun to send it off. You get that sense of adrenaline accomplishment. Hey, I turned in an issue, or we turned in this segment, and then you have that little time period where you can work on something else. Edits are coming back, and then you get to go the back and forth and really hammer out, hey, this is what I'm trying to say. This is why. What's the simplest and easy way we can say this to reach a massive, massive audience? And like you said, if we have to use that lingo and financial terminology, we break it down. I love the example you always give of, hey man, just act like you're sitting on a bar and talking to somebody, and relax and just be normal. And, good thing for me. I'm comfortable doing that. And I like having a drink at a bar every once in a while.
No, I hear you, and that's. And I'm glad we're talking about this, because a lot of you out there, and listen, we're doing a little bit of a different interview style today, right? We like to have, we do have an analyst on. It's going to give picks and stuff like that. But I get a lot of questions. Hey, how Daniel's doing? You had him on like over a year ago. I'm curious. So I just wanted to definitely give you guys an update. But what you're used to if you're a subscriber to our services is the product, right? You get, hey, most of we publish on Wednesdays, most of our services, and you get it on Wednesday and everything's cool. But the process before, people have to work through the weekend. It's going through editorial. You're putting charts and graphic designs in there. So we have, a graphic designer. You're looking at, again, that whole publishing, then, making sure it goes out to everybody and your systems are working. It's a very difficult process where, it's pretty cool. And again, it's behind the scenes for any business is a difficult process, because what you're seeing is just the end product that you're buying. But it is, you need a great team to really make this business work. You can't do it by yourself. You can't just say, hey, this is what I'm going to, you need people to check your work. You need people to make sure, because, how busy we are. You want someone to fact check, making sure they're going over everything. You might have wrote a number wrong, because, not that I do have tons of numbers in our research and making sure that you understand it, but you need that whole team to come together to really get everything to work. And it's really cool that you just took us through that process, Daniel. Now, I want to move on here, because what people love is new ideas. So some of the things that you're looking at, and by the way, Daniel's an analyst, and every one of my analysts, I never tell anyone what to write. I may have different opinions than them, which is fine. That's great. So I don't even know what pick Daniel's going to say or what he's going to say or anything, but this is from him. This isn't, hey, we researched these stocks, Daniel mentioned this. No, this is freestyle. I told him, don't kiss my ass. I want to, give people a real scoop, because I like that. That's real. And that's what I love about this business. It's just a lot of real people in it, at least the people that we hired. But talk about some of the stock picks that you like.
Yeah, I'll give you a couple from two different views. The first one, as you know, from just being right next to you for so long and getting a lot of that downtime and talking throughout the day, I like looking at things from a macro view. I love politics. I love the back and forth banter and arguments and ridiculousness on both sides. Thank goodness I can laugh at it, because it probably drives me crazy like it does most people, and they get so frustrated and yelling at the TV. Hell, half the time you don't know if they're watching a sports game or the news, which just cracks me up, to tell you the truth. But from a macro perspective, I believe you touched on it in the last Curzio Venture opportunity. There's so much algorithmic trading going on, and you see these massive swings in large, it doesn't matter if it's a large cap or a small cap stock. A few to several weeks ago, Target, which is a massive company, over $40 billion market cap, reported earnings, and the stock went up 18 to 20%. I remember standing in the doorway in your office, and we were laughing, and we were like, yeah, in 24 hours, this is worth 20% higher now, because it had strong earnings, and, everybody thought retail's dead, and now it's okay. So the volatility is kind of crazy. And what that's kind of pushed me towards is, I explain the politics, because what I think is going to happen in the stock market is relatable to politics. And what I mean by that is, right now you have a lot of division in the political sentiment, and you have the right and the left not even really wanting to hear each other out or talk at all. And I think that's going to transition over the stock market, in the sense that people are going to continue to go after the specific brands and tastes that they like. And what I think is going to come from all this going forward, even though we're going to have to deal with more volatility, I would like to see, and I'm hoping, that individual stocks start trading on individual bases. So it's not going to be a sense where, and we're starting to see some of that now, you have massive swings in the overall stock market, but individual stocks are, kind of bucking the trend either up or down. So I've been pushed towards higher price stocks. Now, I want to take a small rabbit trail here and explain one of the things that you and I have talked about a lot. And if we could teach the individual investors something, especially the younger investors around my age, in their low 30s, is that the price of the stock is basically irrelevant. And I have met a lot of people, both, successful and in the investment business and just regular investors, that will not buy a stock if they can't buy 100 shares or 200 shares or an even number or something like that. And that is just crazy to me. So you have to remember, it doesn't matter how many shares you owned. It's all about the amount of money invested. And so whether you have 1 share or 10 shares or 100 shares, if that stock goes up 25%, you've made 25% return. So what I say all that to, I would push people to look at higher price stocks. So Booking Holdings is, give or take $1,800 a share. It's got incredible margins. It's a wonderful cash flow business, and it's a great pulse on the, not only the U.S. economy, but nationally, because people are booking flights all over. And when you read through their conference calls, you hear things about, well, there's this holiday over here in this region, or this sports game or venue going on, or World Soccer Cup, and we've seen people in traffic go up or down. And it's just amazing to kind of get that pulse. So I like Booking Holdings, even though it's, quote unquote, a high price stock. The stock has sold off recently, and I think the management is doing a great job on looking to invest and continue to have huge margins and make great acquisitions. And I think that company has a good opportunity to at least reach its past highs. I would, even though they're household names, the high price stocks like Amazon, I remember when you wrote that up in CRA, we kind of joked and said, nobody's going to buy this because it's such a high price stock. We even put a note at the bottom of that issue explaining, don't worry about it, the high price, it's all about money invested. And that turned out to be a huge winner for us. But hopefully everybody bought that. But, I would probably say a lot of people ignored that because it's a household name and it's a huge, a high price stock. Facebook is another one. I would look into any companies that are about to get, news broke just the other day about Google, I think having 49 or 50 attorney generals looking into their business practices. Facebook's the same way, Apple, all these antitrust. If that gives you a knee-jerk reaction in the stock price to go down, I would look at buying some of those just on sheer, even if they get broken up, they're going to be massively powerful and produce tons and tons of cash flow. So, I would almost look at that as an opportunity whenever you hear politicians say, oh, we're going to go after them and break it up. Look at what that did for Rockefeller and Standard Oil. Politicians are not going to be in the business of transitioning power on the corporate level yet. They're all about just getting votes, and they're going to say whatever they need to do that. So any any pullback from Google or Apple or Facebook, I would look to be a buyer on. The other stocks I like are high dividends. I think yesterday was incredible, and I think there was a lot of foreshadowing to that. I know you saw the news where Elliott Management, which is a billionaire hedge fund outfit, took over a $3 billion position in AT&T, and you saw that stock. I think it closed up 4%, but at one point I believe it was up 7 to 10% yesterday, just on that news. And again, here you have a massive company with a huge dividend. But you have a shareholder coming in and shaking up a $200 billion plus company. So I think if you screen for high dividend stocks, you could expect more of that management. And with interest rates being low and the Federal Reserve basically telling you they're going to be low for damn near forever, I think more money will flow into high dividend stocks, and you'll see more activists in that. And then kind of dialing down to the micro level, I want to focus on strong brands. From a trading opportunity, I look at Yeti. They make crazy expensive coolers and mugs to drink out of, but I see them flying off the shelves here in Ohio, and I got a lot of camping and outdoors people here in Southwest Ohio where I'm at, and there's a lot of Yeti cups and Yeti coolers, and everybody just loves them. So if we can get a growth stocks have sold off recently, but if we can get some calmness on the China-U.S. trade deal and growth picks that back up, which I would think it will, I think Yeti can outperform and continue its rise higher too. So, there's a handful of stocks. I don't know if you want me to go on, or I feel like I'm rambling a little bit.
No, that's what people love. They love that. I'm glad you brought up Amazon, because when I recommend that for Curzio Research Advisory, that's our lower price newsletter. A lot of you have subscriptions to that who listen to this. I knew that few people would buy it. And I know that people aren't paying for my service to buy Amazon, right? You can get that from any place. You don't need me to type. But that was through heavy screening of cloud companies. That was through heavy screening of everything. And I really dialed down when I looked at Amazon, and it was in the 900s. It was, I was like, this thing's it's cheap. It's cheap right here. It's going to skyrocket, go through the roof. There's nothing I could recommend in that space that would have bigger gains. And you might have seen a few stocks here and there that have, in the cloud space, but it was just ripe for that stock to go much higher. I recommended it. Like you said, we put a note in there and said, look, guys, we understand this stock is high, because I know we understand where it is, and I get it. But this is a stock that we're very confident is going to go a lot higher, and almost double for us, and we took half off. But remember, guys, with Daniel, just to get into further what Daniel was saying with higher price stocks, because the market is going up, you see more companies, 60, 70, 80, over $100 stock prices. When you look at that, it's all about percentages. If you put $1,000 into a $150 stock and it goes up 20%, you're going to make 20% of your money. It's the same thing that happens if it's a stock trading at $1, right? That goes up 20%. It's the same thing percentage-wise. It's just don't get caught up in the shares, like you said, because the price is meaningless. It's all about the underlying fundamentals, and some companies may have more shares outstanding. So one company could have a $150 stock price and have a $10 million, $20 million market cap. And another one could have a $25 billion market cap. It's all about shares outstanding. And, like you said, with catalysts, in this market today, nobody likes value, and you really have to focus on what's the catalyst that are going to turn things around. And they should be short term, within 12 months. But I like that you covered all that, Daniel. That was really important, and I just wanted to elaborate a little bit more. Now, moving on here, I want to just, kind of end this, because you did provide a lot of great ideas here. I want to make sure that you're practicing golf, because the last time I went out, I did pretty well. Probably the best I shot since we've been here. And Daniel, I try to go out. If I had to guess, we'd get out once a month, twice a month, because we're really busy. But I used to get out twice a week before I started my business. But Daniel's a very good golfer. But I'm just hoping you're practicing, because last time I think might be the first time that I actually beat you at every time we ever went.
Man, I'm telling you, that was hilarious. You guys got to give Frank credit for continuing to play with me. I think I lost 7 golf balls off 7 tee boxes. And I was really hacking, and I got out last weekend. I didn't play. You know what? The game sucks right now, Frank. I'll be honest with you and everybody else. It's frustrating, but I will say I will get a lot better when I get back to Arizona. I will practice a lot more, and my game will come back around. But yeah, it's great to get out. That's one of the escapes you and I both use to kind of unwind a little bit from the business. And I definitely look forward to it. But not practicing enough yet. But I'll get back to it. Next time I come back on, we can recap on that, and we'll see if I can get some more birdies.
All right, you got it, man. So listen, Dan, thanks for taking the time to come on. I was amazed at how many of you emailed us. Hey, I just want to say how Daniel's doing. Dan's going to be writing his own products pretty soon. Everything's amazing, as you could see, from just in 2 years of, for me, Daniel, I just want to thank you. I mean, you brought it every day. You still bring it every day. It's great. And it's because you're passionate about what you do, and it's awesome. So I really appreciate you coming on. You will be coming on in the future. And guys out there, if you have, part of the Curzio Research ecosystem, you are going to start seeing Daniel's name on a lot of different things as, especially his new products, which we're trying to launch pretty soon. So really good stuff. And Dan, thanks so much for coming on, man.
Hey, man. Thanks, Frank. Great talking to you.
All right, guys. Great stuff from Daniel. And I wanted to hear from someone that's not me about the financial newsletter industry. I mean, Daniel is the one person that works with me all the time, that knows exactly what I'm doing, where I'm going, what we eat for lunch together. So yeah, he can give you that bird's eye view of everything that I do, which is cool. But that dedication of him being here for so long, you could see it, right? I mean, he's a full-fledged analyst. He probably is smarter than 90% of the stock analysts in the world. I'm not saying that to be arrogant, but here is kind of like my education when I went to Jim Cramer. You get thrown into the fire. You need to know everything. You're going to learn how to write. You're going to learn about every stock, every sector, everything. And if that's something that you love, then those are the people we like to hire, especially for me, because I'm in charge of hiring the analysts here. We have other divisional heads for editorial and copywriting that, they'll hire who they hire, and I trust them to do the right thing, and they're in managerial positions. For me, that's what I look at. I look at someone who's a diehard that wants to be successful, because if you have that drive in this industry, people are going to hire you. They're going to see it in your eyes. Because anyone can write anything they want in a resume, but to get in the door, you want to be different. And how do you be different? You're going to work harder than anyone else. First one there, last one out. That's what they love to see. Because that's when they're going to open up to you, those bosses, the people who are smarter than you, and say, hey, this guy really wants to learn. He's worth my time, compared to people looking at the clock waiting to leave. It's not for everybody. Some people are like, hey, I only want to work 5 hours a day, 8 hours a day. I want to go home. That's fine. That's cool. There's nothing wrong with that. But for this job, it's different. And you see how far he's come, and now, going to head at least 1 or 2 products going forward. Really, really good stuff. Happy with the job he did. He's a great guy. But guys, that interview, it was a different interview. He did give stock picks. A lot of requests to get him back on, but this podcast is about you, not about me. Let me know what you thought. FrankCurzioResearch.com. It's Frank at CurzioResearch.com. Again, most interviews, we bring in analysts just like Daniel, but they're not giving me the inside scoop of everything that's going on. But I know I get a lot of questions on that, so hopefully you guys enjoy it. Now, let's get to my educational segment. It's going to be a good one. So, Chipotle was on fire from 2010 through 2015. I mean, everyone loved the food, the stock, couldn't do no wrong. The stock was trading around $60 in 2010, surged to more than 700 by 2015, more than 1,000% returns in, around 6 years. But in 2015, you guys know this, Chipotle had an E. coli outbreak. So the stock started crashing since the outbreak spread to 6 states, infected 45 people. And then in 2016, they had food poisoning issues at their restaurants where hundreds of customers got food poisoning. When all was said and done, the stock fell from over $700 a share in 2015 to $270 in October 2017. So a 60% decline. I covered this name extensively during this period, largely telling you to avoid the stock when it was trading over 500. And that calls in part due to you, as hundreds of you writing and telling me most of the stores, you guys, just like me, love Chipotle. And these are places that have lines out the door, and over 90% of you respond. I'm talking about over 100 emails. So a good sample size in the U.S., right? That these places are no longer crowded. And when I look what management was saying, hey, basically telling the public that they're going to continue to see huge growth in same-store sales in 2016, 2017, during that food crisis, I said, no way is that going to happen, guys. A lot more risk. And we were right, thanks to you guys. It's good about this podcast. That's why I love when you guys write in, FrankCurzioResearch.com. Fast forward to today. Chipotle is trading at $830 a share, which is a new all-time high. Pretty remarkable, given the huge problems the company faced from 2015 to 2017. Now, food poisoning, E. coli, obviously not good things, especially if you're a restaurant. But management did a fantastic job addressing the problems. Right, this is something that few restaurants ever voluntarily do. I mean, it closed every store across the U.S., and this was on February 8th during a lunch rush to hold a company-wide meeting to discuss these changes. This included a new safety program, which was also a new DNA testing of ingredients before being shipped to Chipotle locations. They made changes to food preparation, sterilized chicken and steaks before they served them. New employees were trained. It was mandatory. They had to be trained on safety standards before they started working there. And I thought this was cool. They paid workers for taking sick days. So, hey, if you're sick, stay home. This way you're not handling the food. We don't know what you have, but you're handling food. So stay home. And they said, hey, we'll pay you for staying home. Obviously you can't take advantage of that and say you have a cold every 3 weeks, but you don't really want to see people handling food when they're sick, have the flu, or have a contagious cold. They also spent over $10 million to help local farmers meet their new safety standards. In short, what happened to Chipotle was not something that was secular. Wasn't long term. It's not like the streaming movie industry came here and no one's buying DVDs anymore. And 5 years ago, you saw the writing on the wall, 7 years ago, 8 years ago, and DVDs are not going to be around pretty much. They still are. Actually, it was a line of Walmart. Someone bought, what was it? Tommy Boy on DVD. So a guy in front had Tommy Boy on DVD. I was like, you can't get that anywhere. You paid like, I think it was like $14. I just like, anyway, no, get off track here. But it's not, with Chipotle, it was a short-term problem, wasn't secular. Right? It was a temporary problem. It was a problem that lasted for a few years because it wasn't just E. coli, it was food poisoning. They needed to fix that right away. And by doing so, what do? They strengthened their brand. We all fall, all of us, right? None of us are perfect. Okay, what defines us, what defines character, what defines a business is what they do when times are bad. Because when times are good, everybody wants to be your friend. You know who your true friends are when things are bad and you're in a gut and things aren't good, and the people out there, those are your true friends that love you. With businesses too, they're identified of how they go through these boom and bust cycles. Same with the gold market. That's why you see not every junior miner is going higher, even though gold prices are going higher, because a lot of these guys diluted the hell out of the stock. They still have shitty projects. Management teams are not that good. They weren't buying more of their stock when everything was down. They weren't, raising money. They were raising money to make payroll instead of going out and buying assets that were dirt cheap because the market crashed, which you like to see. Big difference. Look at Chipotle, they strengthened their brand, which is why the stock had a huge comeback. And I've seen this happen numerous times. You can take McDonald's 2014. They had a date made its way to numerous restaurants in China, Japan. Customers stopped going to these McDonald's in these areas, which accounted for more than 10% of sales. The stock got crushed on the news. Basically, it was like a 4-year period where McDonald's didn't move before really surging. But again, it took a while to gain the public's trust back. McDonald's put better safety measures in place, and the stock more than doubled from its 2014 lows. Go back to the 80s, as far as the J&J. 7 people died. Remember the cyanide-laced capsules? I know the millennials listen. It's a little bit, before your time maybe. But a lot of people, especially retired, you definitely remember that story. What did J&J do? Immediately pulled Tylenol from the market. 31 million bottles. Took them all off the market. And you know what that led to? The creation of tamper-proof bottles. So they use a negative and turn it into a positive. Yes, the stock got hit. Yes, it was terrible. But the company did the right thing and said, we have to avoid this problem going forward. Just like Chipotle, just like McDonald's. J&J, last I heard, is a pretty big company today. So the purpose of this segment is to know the difference between a risk that's secular, where if it's secular, maybe the business is actually being disrupted, you have to worry about, from a temporary risk. Because temporary setbacks, especially if they result in a PR nightmare, right, where it's everywhere, it usually crushes the stock. That was the case in every example I just mentioned. If you do your homework, have a little patience, and can handle the volatility, because it's not going to be, a straight line back up, since you never know, it could be like Chipotle and take several years before they get their act together. You could make a ton of money on these names. Why? Because they fall to levels that are dirt cheap when nobody wants them, and they're hated. And buying hated stocks, especially good brand name stocks that just have these temporary setbacks, create amazing buying opportunities. Where am I going with this? There's one company right now in the market going through a lot of companies, but one specifically that you all know is going through a PR nightmare, and that's Boeing. I covered this extensively with you guys. I told you guys, hey, this is with the 737 MAX jets, right? Guys, if you don't know, the 2 planes that crash were 737 MAX jets, but Boeing has been conducting safety tests. Problem was supposed to be fixed right now, but it's still not, still ongoing. This resulted in several customers canceling their orders for the MAX. They lowered their their growth outlook for how many Maxes they're going to sell. Airline companies still have these planes grounded. I'm going to put the 737 MAX in perspective, like I did when I told you to avoid the stock after this first happened. And it's down a lot since then. Roughly 1/3 of the 24,000 global passenger planes right now are 737 MAXes. And about 2,800 of them are in the air, usually at one time, give or take, when these planes are actually working. Pretty crazy. Now, you're looking at Boeing, watch his stock fall hard since the first crash took place, and that was in October 2018. And while another MAX 737 crashed in March, a few months later, people don't know this. I don't think this was much of a headline because it just got dismissed. But in November 2018, so right after the October 18 crash, there was another plane that had an emergency landing as automatic safety system kept pushing up the nose of the plane down. So it was an emergency landing. And nobody really talked about that because you hear about that a lot. But then when you had the crash again, which was in March, then everything was like, whoa, there's something wrong with these planes. Now, the stock traded as high as 440 earlier in the year. Okay, this is about February, 1 month before the second crash. And Boeing right now still struggling to get the right safety measures in place to get the planes back in operation. They're pretty close, but the stock is trading around 350-ish. This is a problem that's not going to last forever. In fact, probably not going to last longer than 6 months to a year before they get these planes back up and everything's cool. And that's important considering Boeing. There are 100 customers still waiting for over 5,700 of these planes to be delivered to them over the next few years. 5,700 of unfilled orders. Why so many? Because the MAX provides 10 to 20% fuel efficiency, which results in massive profits and extra profits for airlines since fuel is their biggest expense. So once everything passes FAA and they get this figured out, Boeing's going to be back on track, back in growth. In the meantime, looking at Boeing. This is a name I told you to avoid for over 9 months. If you listen, you definitely save some money. But today, Boeing reminds me of Chipotle back then. Except it's not going to take years for the company to recover and hit a new high. I think we can see this happen a lot sooner. And even if it takes a little bit longer, say 12, 18 months, 2 years, you're getting paid at 2.2% yield to wait, which is a nice dividend in a market where, what do we have? 0 interest rates and 17 trillion government bonds have negative yields. Not bad. But this problem is close to being over. It makes them a stronger company. Again, we talk about your money here. Okay, there's people that actually died from this, which is terrible. I get it. I'm talking about the stock here. If you look at Boeing, where it is, and this news is just temporary. Yes, they saw a couple of orders get it canceled, but most of these guys are still waiting for their planes over the next few years, 5,700 of them. And now they're coming out with a new plane that, if you notice, just had a few safety issues, a minor safety issue. They put it through crazy turbulent conditions, and the doors blew off. So it'll be interesting, but they'll be able to fix that problem too. But at the end of the day, there's huge demand for these planes. These are going to be more safer than ever because they're going to be conducted through numerous tests before they go back up there. And once they do, you're going to see the orders start flowing again, and this company's easily going to make their earnings. Everyone dialed down their earnings finally for Boeing. It's a much cheaper stock than it was a year ago, and I could see it following the same fate as Chipotle. So real quick to sum it up, this education segment, guys, be smart when you see these companies, these big PR nightmares when something happens, especially if they're brand name companies. Doesn't mean you go out and buy them right away, but there's going to be a long period of time. This is like a year, 6 months to a year, where they go through all of this, hey, we're going to make our company better, and, it's going to be a nightmare, and they might miss earnings and estimates a couple of quarters, just like Chipotle, McDonald's, J&J, and even Boeing. But at the end of the day, these are temporary problems. Most of these great companies have tons of money, billions on their balance sheet, where they can withstand this. And more times than not, it creates a great long-term buying opportunity. Whew. Long podcast today. Covered so much, which is really cool. Love covering a lot for you guys. But saves all the time. Questions, comments, anything, I'm here for you. Email me, frank@curzioresearch.com. That's frank@curzioresearch.com. So, guys, that's it for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.